Right now, the market is coiled up like a spring. We're sitting at a critical technical inflection point, squeezed between a massive wall of government liquidity on one side and some really serious cracks in the fundamental data on the other.
So the only question that really matters for our P&L is, which one of these forces wins out? Are we looking at a powerful breakout to new all-time highs, or is this the start of a breakdown that finally validates the bear case?
All right, here's the number you need to burn into your screen. 6770 on the S&P 500. This is the absolute line in the sand. It's the key resistance. You can think of it as the call wall separating the bull and bear scenarios. A decisive move through this level, one way or the other, is almost certainly going to trigger the market's next big tradable leg.
Okay, let's get into it. The data we're seeing is sending completely different signals. It's a real tug of war. So here's what we're going to do. We'll break down the bull case, then the bear case, and then, most importantly, we'll build a clear playbook for what comes next, based on specific price action.
All right, let's start with the bull case. And let's be crystal clear. The argument for higher prices right now has almost nothing to do with fundamentals. It's all about one thing: liquidity. We're talking about a massive, overwhelming wave of money that simply has to find a home.
So where's this money coming from? Well, the primary driver is the U.S. government's annual deficit spending. We're talking nearly $2 trillion, based on the latest CBO projections. This is a straight-up fire hose of liquidity getting blasted into the economy. And that creates this huge artificial tailwind for financial assets. You just can't ignore it.
And then there's the Fed. The market's expectation here could not be clearer. If you look at the CME FedWatch tool, it's pricing in a 96% probability of a rate cut at the next meeting. This right here is the single biggest narrative driving stocks right now. The market is making a huge bet on cheaper money, and it's positioning aggressively for it.
And it doesn't stop there. You've got other bullish factors lining up too. First, seasonality is a monster tailwind for November and December. Second, market breadth looks solid. The advanced decline line is hitting new highs, which tells you participation is broad-based. It's not just a few big names. And finally, seeing the 10-year Treasury yield dip back below 4%, that takes a huge headwind off the table for valuations.
Okay, that's the bull case. It's compelling. But now we have to look at the other side of the trade, the bear case. Because while that liquidity story is powerful, the underlying fundamental picture, well, it's getting ugly. There's some serious cracks starting to form just beneath the surface.
First up, valuation. Let's just look at the numbers. The Buffett indicator, which compares the total market cap to GDP, is sitting at 221%. Now, to put that into perspective for you, that is higher than the absolute peak of the dot-com bubble. So by this classic long-term metric, valuations are, to put it mildly, extreme.
And here's where the systemic risk comes in: margin debt. According to the latest FINRA data, we're seeing a scary re-acceleration in margin debt. The amount of leverage in the system is spiking to levels we've seen right before the major crashes in 2000 and 2007. You know, this is the kind of dry tinder that's just waiting for a spark.
At the exact same time, the consumer is clearly showing signs of stress. I mean, the data doesn't lie. According to the New York Fed, credit card delinquencies just hit a 14-year high. And on top of that, we're watching the ratio of consumer discretionary to consumer staples stocks just break down. That's a classic signal that people are cutting back on the wants and focusing on the needs.
So this is the core conflict, right? This is the whole ballgame. On one side, you've got this tidal wave of liquidity and the promise of Fed rate cuts. And on the other, you have dot-com level valuations, scary levels of systemic leverage, and a consumer that's clearly on the ropes. This is the battle that's playing out in the price action every single day. Okay, so with that setup, where is this battle actually being fought on the charts? Let's drill down into the key sectors and levels that are going to tell us which side is starting to win. All right, the main event is obviously the S&P 500, specifically the zone between 6770 resistance and 6500 support. That's the kill zone. But you also have to be watching semiconductors. They're the market leader, the canary in the coal mine for the entire tech sector. And as we just talked about, that consumer discretionary versus staples ratio, that's your direct signal on the health of the economy. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. Do your own research. This is not financial advice. Okay, analysis is great, but execution is what matters. So let's translate all of this into a practical game plan. We need clear, unambiguous triggers that tell us how to adjust our posture, whether we should be positioned for a choppy range, a clean breakout, or a nasty breakdown. For me, the base case right now is just a chalky, volatile range. You've got that bullish seasonality providing a floor, but the bearish macro risks are going to put a ceiling on any rally. So the prudent posture here is defensive. That means reduce leverage and keeping a good chunk of your powder dry, say around 19% cash, so you're ready to deploy when we get a real signal. So what's the bull trigger? It's simple. A decisive daily close above 6770 on the S&P. A move like that would confirm a breakout and could easily ignite a gamma squeeze, where dealers get caught offside and are forced to buy, pushing the market even higher. The response here is clear. Deploy that cash and start adding long delta to your book. Now on the flip side, the bear trigger is a decisive break below that 6500 support zone. A move like that completely invalidates the short-term bull thesis, and it opens the door to a potential cascading sell-off. The response? You hedge, you raise even more cash, and you start mapping out your entries for short positions.
All right, let's make this more concrete. Here are a couple of examples of how you could structure a trade in this kind of environment, one for the bearish side and one for the bullish side. Okay, for a potential bearish setup, take a look at Alnylam Pharmaceuticals, ticker ALNY. The thesis here is a counter-trend reversal. The stock just punched a new high, but if you look at momentum indicators like the RSI, you're seeing clear bearish divergence. That's a classic sign of buyer exhaustion. So a defined risk way to play this could be a bear put spread. It profits if the stock drops, but more importantly, your max loss is capped from the start. Now for a bullish idea, let's look at Tesla post-earnings. Let's say it pulls back to a key support zone. A potential strategy here would be to sell cash-secured puts. It's a win-win setup. Either you just collect the premium if the stock stays above your strike, or you get to acquire the shares at a much lower effective cost basis if it does drop. It's a smart way to get paid to wait.
Okay, so let's wrap this up and get down to brass tacks. What are the absolute critical data points and levels you need on your screen right now?
Here's your checklist. Number 1, that S&P 500 support zone, 6,500 to 6,550. It absolutely has to hold for the bulls. Number 2, the upcoming CPI report. A hot inflation number could completely derail that rate cut narrative overnight. Number 3, watch the reaction to Tesla's earnings. It's a huge bellwether for overall risk appetite. And finally, keep an eye on the VIX. If it makes a sustained move back above 20, that's a major warning sign. It signals a shift to a high volatility environment, and that is not good for the bulls. Not trading advice, just a market update to keep you informed. Markets carry risk. Trade your plan, manage downside, and verify all data.